In the summer of 2021, the impossible began to happen. The seemingly invincible titan of Chinese real estate, Evergrande Group, started to wobble. For decades, its founder, Hui Ka Yan, was a figure of almost mythic status. A man who built a $300 billion empire on concrete, debt, and sheer force of will. His yachts, his private jets, his opulent lifestyle, they were testaments to a reign that seemed untouchable. But then, the whispers became roars. The first missed payment arrived, a hairline fracture in a foundation built on borrowed time. Imagine standing on top of the tallest building in Shanghai, looking down at the city you helped build, only to realize the very ground beneath you is liquefying. This wasn't just a corporate bankruptcy, this was the systemic failure of a nation's economic miracle. When Evergrande officially defaulted, it wasn't just a financial tremor. It was a seismic shockwave that rattled global bond markets, threatening to drag down suppliers, investors, and millions of homebuyers who had placed their faith in a promise of an apartment that might never be finished. Hui Ka Yan, once the richest man in China, watched his $30 billion fortune evaporate not in a single catastrophic event, but in a slow, agonizing bleed orchestrated by the very government he once courted. The collapse of Evergrande is more than just a story of bad accounting. It's a cautionary tale about the seductive nature of infinite growth and the terrifying fragility of a bubble inflated by political favor. How does a man who controlled enough assets to rival the GDP of a small nation simply vanish into the shadows, leaving behind a staggering debt of over $300 billion? The silence surrounding Hui Ka Yan today is deafening, a stark contrast to the constant noise of his empire's expansion. We are about to dissect the trajectory of a rise so fast it defied gravity, and a fall so dramatic it redefined too big to fail. This is the story of Evergrande, and the man whose ambition ultimately became his undoing. To understand the magnitude of the Evergrande collapse, you must first understand the man at the helm, Hui Ka Yan. Born in 1958 in Henan province, Hui's early life was one of provincial hardship. He was the quintessential self-made man, rising from humble beginnings to become the face of China's explosive economic renaissance. By the early 2000s, Hui had founded China Evergrande Group, headquartered in Shenzhen. This wasn't just another construction company, it was an edifice built on the belief that China's appetite for urbanization was infinite. Hui masterfully navigated the opaque waters of Chinese policy, securing land at favorable rates and leveraging massive amounts of debt to fund an unrelenting pace of construction. At its peak, Evergrande wasn't just selling apartments, it was selling dreams. A guaranteed ticket to the burgeoning Chinese middle class. The company's scale was almost incomprehensible. They operated in over 280 cities, employed hundreds of thousands of people, and owned assets that spanned entertainment, electric vehicles, and even a professional football club, Guangzhou FC, which they showered with millions, seemingly without consequence. Hui Ka Yan himself was a symbol of this era. In 2017, he was crowned the richest man in mainland China, his personal net worth swelling to nearly $45 billion. He had the ear of the elites, he commissioned lavish corporate headquarters, and he projected an image of invincible success. This success was intoxicating, not just for Hui, but for the entire global financial system that bought into the narrative. Banks, international bondholders, and private equity firms funneled billions into Evergrande, trusting the implicit guarantee of Beijing's support. The narrative was simple. China needed Evergrande to keep building. But beneath the glossy brochures and perpetual construction cranes, a dangerous calculus was taking place. Hui Ka Yan operated under a philosophy of growth at all costs, believing that the party would never let such a massive entity fail. This hubris led him to pile debt upon debt, chasing ever larger projects, ignoring the mounting pile of obligations to suppliers and prospective homeowners. The company's total liabilities ballooned past $300 billion, a figure so large it required complex financial gymnastics just to keep track of it all. The setup, therefore, wasn't just the foundation of a property giant. It was the creation of a shadow banking behemoth whose fate was inextricably linked to the economic stability of the world's second-largest economy. As the mid-2010s gave way to 2020, however, the landscape began to shift, and the comfortable safety net everyone assumed was there started to fray, revealing the stark reality that the rules were about to change for Hui Ka Yan. The narrative of Evergrande's ascent is a masterclass in leveraging political access and exploiting a specific window in China's urbanization policy. Hui Ka Yan understood that in a system where land access was centrally controlled, relationships were currency. In the late 1990s and early 2000s, as millions migrated from rural China to burgeoning urban centers, the demand for housing was near vertical. Evergrande didn't just participate in this boom. It aggressively fueled it, often through relentless land acquisition in secondary and tertiary cities, snapping up vast tracts of undeveloped land that competitors considered too risky or too remote. The key to Evergrande's velocity was its financial engineering. Instead of relying solely on traditional bank loans, which were often capped by regulatory bodies, Hui innovated a system of pre-sales, what China calls forward sales. They would collect 70% to 80% of a property's purchase price years before construction even began, effectively using the buyer's own money to finance the next project. This created a self-perpetuating debt machine. Imagine receiving a loan for construction today, and realizing that loan is actually repaid by the deposit you take next month. This system allowed Evergrande to grow its project pipeline exponentially, with reports suggesting that at its zenith, they had over 1,300 active construction sites across the nation. This financial strategy was ruthlessly effective, driving the company's revenue from relatively modest figures in the early 2000s to revenues exceeding $80 billion annually by 2020. Hui Ka Yan was never shy about his ambitions, famously declaring in 2010 that Evergrande would become the #1 property developer in China, a goal they achieved, not just by size, but by sheer operational breadth. Beyond residential towers, Hui diversified into nearly every sector imaginable: insurance, healthcare, electric vehicles, Evergrande Auto, which reportedly received billions in investment, and, famously, the Guangzhou Football Club, which he turned into a national powerhouse, signing expensive international players, projecting an image of untouchable success that further burnished the brand's credibility among investors. This period was characterized by aggressive marketing and hyperspeed construction. When a project was late, it was because Evergrande was busy acquiring a new city block. This high-octane lifestyle was funded by the international debt markets. In 2016 and 2019, Evergrande successfully issued billions in offshore bonds, borrowing US dollars from global investors who saw the company as a proxy for China's guaranteed economic ascent. These bonds carried high yields, attracting capital from major US and European asset managers, who valued the perceived implicit backing of the Chinese state. In 2019, Hui Ka Yan's personal fortune peaked, solidifying his status among the global elite, dining with heads of state and hosting massive, extravagant corporate events, all while the ticking clock of the company's massive interest payments grew louder. The entire system was predicated on one unbreakable assumption: that the flow of debt and the flow of homebuyers would never stop. Yet, in the corridors of Zhongnanhai, Beijing's leadership was beginning to look upon this debt-fueled frenzy not as a miracle, but as a systemic threat to financial stability, setting the stage for an inevitable, violent correction that Hui Ka Yan was allegedly completely unprepared for. The seeds of destruction were sown during the height of Evergrande's success, nurtured by a dangerous cocktail of unchecked leverage and Beijing's shifting economic priorities. The first significant sign that the party was coming to an end arrived not from a missed bond payment, but from a policy shift originating in the highest levels of government. In 2020, as concerns over housing affordability and systemic financial risk grew louder, Beijing introduced the infamous Three Red Lines policy. This regulatory framework was designed to forcibly deleverage highly indebted developers. It mandated strict ceilings on debt relative to assets, cash to short-term borrowings, and debt-to-equity ratios. For a company like Evergrande, whose entire business model was predicated on maintaining a massive debt-to-equity ratio exceeding 200%, the Three Red Lines were an existential threat. Hui Ka Yan, reportedly, initially dismissed these new rules as mere regulatory noise, a suggestion he could negotiate his way around them, as he had done countless times before. This was a profound miscalculation. In August 2020, when the rules were officially implemented, Evergrande found itself instantly disqualified from securing new bank loans until it drastically reduced its liabilities. Suddenly, the engine that fueled their growth, cheap, abundant credit, was cut off. This forced a scramble. To comply, Evergrande desperately tried to slash costs and aggressively sell assets, initiating deep discounts on properties, even selling apartments at near cost just to generate immediate cash flow. This fire sale, however, only managed to bring in a fraction of the cash needed to service their looming debt obligations, which reportedly included around $120 billion in short-term payables to suppliers and contractors. Then came another crucial error: Hui Ka Yan's diversification strategy, particularly Evergrande Auto. Billions were poured into electric vehicle manufacturing, a capital-intensive business with minimal returns in the short term, effectively draining liquidity from the core property business precisely when cash reserves were critical. Adding to the complexity, Evergrande had developed a vast, opaque network of wealth management products, WMPs, sold directly to individual investors, often disguised as safe investments offering high returns, reportedly between 8% and 12%. These WMPs acted as shadow financing, binding hundreds of thousands of Chinese citizens directly into Evergrande's fate. When the first major loan payments began to falter in early 2021, the narrative quickly shifted from aggressive growth to desperate solvency. International rating agencies, finally catching up to the reality of Evergrande's ballooning liabilities, began downgrading the company's credit rating precipitously. By mid-2021, the $300 billion behemoth was hemorrhaging credibility, and Hui Ka Yan was no longer meeting with policymakers seeking favors. He was reportedly fighting for survival against an immovable regulatory wall, a wall that Beijing allowed to stand firm, signaling that even titans could fall. The question was no longer if Evergrande would collapse, but how violently the dominoes would fall when the first major payment was finally missed, a moment that was fast approaching. The descent into insolvency was swift, brutal, and punctuated by specific, devastating deadlines. September 2021 marks the true tipping point. Evergrande missed its first major bond interest payment, reportedly worth $82.5 million. The silence from the company was deafening, triggering a 30% drop in its stock price when trading resumed. This wasn't just a missed coupon payment, it was a declaration of illiquidity. Global markets held their breath, watching to see if Beijing would intervene, fearing the contagion effect across China's property sector, which accounted for nearly 30% of the nation's GDP. Beijing chose restraint, a clear signal that the era of implicit state guarantees was over. In the following weeks, the missed payments mounted. By late September, Evergrande reportedly missed several more dollar-denominated bond obligations, triggering cross-default clauses that made the entire $19 billion outstanding international debt instantly callable. The pressure intensified on the domestic front, where the real danger lay: the unfinished apartments. Hundreds of thousands of homebuyers, having paid their deposits, began organizing flash mobs and protests at sales offices across China, demanding answers and demanding their homes. Meanwhile, construction ground to a halt on an estimated 1.6 million units nationwide. Hui Ka Yan, attempting to show leadership, reportedly pledged $100 million of his personal fortune in October 2021 to pay off some overdue wealth management products. A symbolic gesture that barely covered 0.1% of the total liabilities. By December 2021, the inevitable official declaration arrived. Evergrande formally defaulted on its offshore bonds. This officially began the long, tortuous process of debt restructuring, orchestrated under duress by Chinese regulators. The focus immediately shifted from keeping the company afloat to minimizing social instability. The concept of guaranteeing delivery of the pre-sold homes became paramount over repaying foreign creditors. The company's vast ecosystem began to crumble. Suppliers demanded payment, often turning to aggressive tactics when ignored, reportedly leading to workplace violence and social unrest at construction sites. In 2022, the scale of the problem became even clearer. Evergrande's total liabilities were officially restated, soaring past $340 billion, making it the largest corporate debt crisis in modern history. Hui Ka Yan, who once commanded immense public visibility, disappeared from public view, replaced by grim-faced company executives attempting to negotiate piecemeal deals with creditors. The Chinese government initiated a controlled demolition, prioritizing the orderly liquidation of assets, including the sale of key non-core holdings, often at fire sale prices, to fund the completion of residential projects. By 2023, the endgame was set in motion. Foreign bondholders, realizing they would receive pennies on the dollar, if anything, prepared for a protracted legal battle. In January 2024, a Hong Kong court issued a definitive liquidation order against Evergrande, demanding the company be wound up. This formal ruling confirmed the death of the empire Hui Ka Yan built. The founder, whose personal wealth plummeted from $45 billion to near zero, now faces severe restrictions, allegedly unable to leave certain jurisdictions, stripped of his luxury assets, and living under the shadow of governmental scrutiny. The $30 billion collapse wasn't just a ledger entry, it was the destruction of a financial ecosystem built on the audacity of one man, and the lesson Beijing desperately wanted the world to learn about leverage. The fallout from Evergrande's collapse resonates far beyond the balance sheets of international hedge funds. It fundamentally altered the geopolitical perception of Chinese state capitalism and the viability of its debt-fueled growth model. The primary immediate consequence was the chilling effect on the entire Chinese property sector. Competitors like Kaisa Group, Fantasia Holdings, and Sonic China quickly faced their own liquidity crises, triggering a domino effect that forced a painful, government-managed contraction. The national government's priority shifted decisively: stability over growth at any cost. The emphasis moved from building new housing to ensuring the completion of existing projects, channeling liquidity strictly to whitelist developers deemed essential for social order. For Hui Ka Yan, the personal consequence has been total erasure from the public sphere. Once a symbol of entrepreneurial triumph, he is now a cautionary figure, allegedly detained or placed under strict surveillance by authorities. Reports surfaced in 2023 suggesting that while foreign bondholders were left holding worthless paper, domestic lenders and Chinese citizens who bought Evergrande's wealth management products were prioritized for partial repayment, a clear indication of Beijing's commitment to maintaining domestic social cohesion above international financial order. The $300 billion debt has not vanished. It has been absorbed, restructured, and passed down to local governments and state-owned enterprises tasked with managing the cleanup, effectively socializing the massive private debt. Globally, Evergrande served as a harsh reminder of the opacity inherent in markets heavily influenced by state actors. International investors who once viewed Chinese property giants as too big to fail were forced to radically reprice their risk assessments. The liquidity premium demanded for Chinese corporate debt spiked dramatically thereafter. The lesson for future Chinese titans remains chillingly clear: loyalty to the party supersedes success in the market. Hui Ka Yan's ambition, fueled by the assumption of eternal political patronage, became the very mechanism of his downfall. He bet that the Chinese economy could sustain infinite expansion fueled by mortgages and debt, failing to anticipate that when the government decided the risk outweighed the reward, the support structure would be withdrawn instantly and without warning. Today, the massive, half-finished skeleton of Evergrande's ambition serves as a stark monument to this overreach, a physical reminder that even in the world's most tightly controlled economy, the laws of financial gravity eventually assert themselves. The question now isn't what Hui Ka Yan will do next, but whether China can truly decouple its future from the ghost of the property empire he left behind.